Have you ever asked yourself, how do people truly build wealth and keep it? Not overnight, not through luck, but through a system, a mindset, a discipline that actually lasts? If you've ever felt confused by the stock market, overwhelmed by choices, or burned by advice that promised fast money, then you're not alone. And you're in the right place. Because today, we dive into a book that doesn't just teach investing, it teaches how to think like an investor. This is The Intelligent Investor by Benjamin Graham. Not just a classic, not just a Wall Street favorite, but a book that shaped the mind of Warren Buffett and laid the foundation for thousands of successful, steady investors. But here's the thing, this book isn't flashy. It doesn't promise riches. And it definitely isn't easy. It's deep, it's demanding, and if you give it your full attention, it will change how you see money, risk, fear, and your financial future. So, in this video, we're going to walk through the core ideas of this legendary book, not in 5 minutes, not in a summary, but in a full, detailed journey that takes you chapter by chapter, story by story, principle by principle. Because The Intelligent Investor isn't meant to be skimmed. It's meant to be absorbed. And by the time we reach the end, my goal is simple, to make sure you never look at investing or your decisions the same way again. So grab a notebook, grab your focus, and let's begin the journey into one of the greatest financial minds of all time. This is The Intelligent Investor. Imagine this. It's the year 1934. The world is still reeling from the Great Depression. Markets are in ruins. Families are broken. Fortunes have vanished. In the middle of this chaos, a young man, disciplined, methodical, and oddly calm, sits in a dimly lit office at Columbia University. His name is Benjamin Graham, and he's about to rewrite the rules of investing forever. But that's not how most people remember the markets. When we think of Wall Street, we picture flashing numbers, loud voices, fast trades. We imagine risk, speed, ambition. But what if I told you that the greatest investor of all time didn't believe in speed or hype or even the market itself? That's where the story begins. Graham wasn't trying to get rich quick. He wasn't even trying to predict the market. He was trying to understand it, to decode it, to find a way that everyday people, school teachers, carpenters, office clerks, could invest safely, logically, and consistently for life. And in doing so, he wrote a book that Warren Buffett would later call by far the best book on investing ever written. But here's the twist. The Intelligent Investor isn't an easy read. It's not sexy. It doesn't promise overnight success. It doesn't sell you dreams. Instead, it does something far more dangerous and far more powerful. It teaches you how to think. And thinking, real thinking, is rare, especially with money. Now imagine you're sitting across from Benjamin Graham. He looks at you and says, you are either an investor or a speculator. You must choose. At first, it sounds simple. Of course, I want to be an investor. But then he leans forward and calmly says, most people think they're investing. But what they're really doing is gambling with good manners. You pause. He continues. True investing is not about beating others at their game. It's about controlling yourself at your own. Suddenly, this isn't about the stock market anymore. It's about you, your emotions, your patience, your discipline. And just like that, the pages of this dense, serious book start to feel like a mirror. In this journey, you will meet two characters, Mr. Market and the Intelligent Investor. Mr. Market is unstable. He shows up every day with a different mood. One day he's ecstatic and wants to buy everything at a high price. The next day, he's depressed and wants to sell it all for cheap. If you follow him, you'll be as crazy as he is. But the Intelligent Investor? He doesn't react. He waits. He observes. He decides based on reason, not emotion. He knows that in investing, the most dangerous person is not the market, it's yourself. Let me tell you something uncomfortable. Graham will not make you feel good. He will challenge you. He will strip you of the lies you tell yourself about your knowledge, your instincts, your timing. He will demand that you slow down, that you become boring, that you become consistent. And that's why this book matters now more than ever. Because today, with social media stocks surging and crashing, with influencers offering tips and apps turning kids into day traders, what's truly rare is wisdom. So over the next few hours, we're going to go deep, chapter by chapter, principle by principle, not just explaining what Graham said, but why he said it, how it works today, and most importantly, how you can use it to protect your future. Because this isn't just a book about finance. It's a survival manual for the mind. And once you see investing through Graham's eyes, you'll never be fooled again. Let's continue into part 2, where we dive into chapter 1 and Graham's central distinction between investing and speculating, one of the most misunderstood and dangerously blurred lines in the financial world. You're at a dinner party. The guy across from you says he made a killing in Tesla last month. Someone else chimes in they've been all in on crypto since 2020. The room is buzzing with excitement, with stories of gains, timing, genius. But something doesn't sit right. You remember what Graham said, an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. And just like that, most of what we call investing vanishes in a puff of smoke. Because now the question hits harder. Do you invest or do you speculate? Do you really know what you own? Why you own it? What it's worth? This is where the tension begins. You might be shocked to realize that the real danger isn't losing money. It's not knowing why you lost it. Speculation is seductive. It feels exciting. It rewards fast decisions and punishes doubt. It thrives on hype. But investing, true investing, is built on quiet, deliberate analysis. It's boring. It's slow. It's wise. So, why do most people run from it? Because it doesn't offer certainty, but it demands responsibility. Now here's the dilemma. The stock market is a place where both investors and speculators operate, but the rules, the mindset, the outcomes, they couldn't be more different. Imagine two people buying the same stock. One has spent months analyzing the company, its financials, its competitors, and its intrinsic value. The other just heard a tip on social media. Same stock. Two minds. Two futures. Graham warns us. The market will always tempt you. It will whisper shortcuts. It will show you others winning big. But the moment you forget that you're buying a business, not a bet, you've stepped into the casino. And here's the real twist. Even smart people, doctors, lawyers, engineers get trapped. Not because they're unintelligent, but because the market doesn't test intelligence. It tests temperament. It's not about IQ. It's about emotional control. This is the hidden war inside the intelligent investor. It's not fought on Wall Street. It's fought in your own mind. Against greed, fear, pride, and impatience. The book doesn't just teach formulas. It teaches character. Let's take a breath and think. Why do so many people fail financially despite having access to more information than any generation before? Because information isn't wisdom. Because knowledge without discipline is still dangerous. Graham's first lesson is clear. Before you learn how to invest, learn who you are when the money's on the line. Are you someone who reacts or someone who reasons? He's not asking you to predict the future. He's asking you to survive it. And that brings us to a chilling insight. You don't need to be extraordinary to succeed. You just need to avoid being foolish. The intelligent investor isn't about beating the market. It's about not letting the market beat you. So here's the fork in the road. One path is crowded, loud, full of urgency and dopamine. The other is quiet, slow, deeply uncomfortable, and deeply rewarding. Graham urges you to take the second path, to become a rare kind of person. The kind who watches the world panic but waits. The kind who sees a crowd run but pauses. The kind who doesn't chase returns but builds wealth. And that kind of person doesn't gamble. Let's continue. In part 3, we journey into chapter 2, where Benjamin Graham shines a light on a quiet, invisible thief, one that's stealing from you every day. You can't hear it. You can't feel it. But it's there, slowly eating away at your wealth, your savings, your future. Its name is inflation. Picture this. You've worked hard, saved every month, built up a solid account. You sleep better knowing your money's safe. Until one morning, you walk into a store and prices have risen. Again, and again, and again. And suddenly, the truth hits. You didn't lose money, but you lost what it could buy. This is the betrayal that Graham wanted you to see. In 1949, when The Intelligent Investor was first published, people believed cash was king. That if you saved enough, you were safe. But Graham looked deeper. He saw the numbers. He saw history. And what he saw terrified him. Inflation, this slow, creeping rise in prices, wasn't just a temporary blip. It was a permanent threat to the value of your money. And that changes everything. Imagine putting $100,000 under your mattress. You protect it, count it, feel secure. But fast forward 10, 20, 30 years, and that money? It's still there, but it's not worth the same. Because while the number didn't change, the world around it did. Prices doubled, tripled. Your $100,000 is now a shadow of its former self. Graham knew most investors weren't afraid of inflation because they didn't see it. It's not like a market crash. It doesn't shout. It whispers. Slowly, silently. And that's what makes it so dangerous. Here's the twist. Even conservative investors, trying to play it safe by staying in cash or bonds, were unknowingly walking into a trap. Because if your return doesn't beat inflation, you're not preserving your wealth, you're surrendering it. Now you're caught in a conflict. On one side, the comfort of cash safe, visible, easy to understand. On the other, the volatile, unpredictable world of equities, real estate, and hard assets. Graham doesn't push you. He doesn't shout. He teaches. He shows you that risk isn't just about losing money, it's about losing purchasing power. So, what's the intelligent investor to do? You need more than just safety. You need growth with discipline. You need investments that protect you not just from market crashes, but from the silent erosion of time. Enter equities. Not because they're exciting, not because they're fast, but because they represent ownership in real businesses. Businesses that can raise prices, increase earnings, and outpace inflation. And here's the conflict again. Stocks come with emotion, volatility, uncertainty. And that's where most people break. They want growth without pain, safety with speed. But Graham teaches you, you can't have both. You must choose to endure the discomfort of temporary losses, to avoid the destruction of permanent erosion. And this is where his brilliance shows again. He doesn't give you a map. He gives you a compass. He teaches you to measure your returns not in dollars alone, but in real value, what those dollars can do for you in the future. It's not about numbers. It's about freedom. So now, look at your money. Not as a pile to protect, but as a tool to preserve power, dignity, and choice in a world that's constantly changing its price tags. Because the truth is, wealth isn't about what you have. It's about what you can still afford to lose. And unless your money grows faster than inflation, you're not staying in place. You're quietly slipping behind. Let's move into part 4, where we meet one of the most iconic characters in investment history, Mr. Market. This chapter isn't just theory. It's psychology. It's a masterclass in resisting the chaos of the crowd and, most importantly, resisting yourself. Every day, someone knocks on your door. He's polite, punctual, and always eager to make a deal. Sometimes he's thrilled he'll buy anything you have for double the price. Other times, he's depressed. He's desperate to sell his things at rock-bottom rates. His name? Mr. Market. Benjamin Graham's greatest metaphor isn't about the stock market, it's about human nature. Mr. Market isn't real. He's a symbol, a reflection of the emotional ups and downs of every investor. But Graham wants you to imagine him as very real. Because every time you look at a stock quote, every time the news flashes red or green, it's Mr. Market knocking. And here's the kicker. You don't have to answer. You don't have to buy what he's selling. You don't have to sell what he's buying. You don't even have to let him in. But most people do. They not only let him in, they follow him. They buy when he's excited. They sell when he's scared. They confuse his mood with reality. And that, Graham warns, is the road to ruin. Because Mr. Market is not rational. He's manic. He doesn't care about value. He only reacts to sentiment. And if you let his emotions become yours, you've already lost. Now here's the twist. Mr. Market isn't your enemy. He's your servant. He exists to offer you opportunities, but only if you have the strength to ignore him most of the time. Graham says, the true investor is in that very position when he owns a common stock. He can take advantage of the daily market price or leave it alone, as dictated by his own judgment and inclination. That's revolutionary, because it means that you are in control. Not the headlines, not the hype, not the herd. You. But that kind of control isn't easy. It requires clarity, patience, and the ability to sit still while others panic. Let's create a moment. It's March 2020. The world shuts down. The market crashes. Mr. Market is in full-blown hysteria. He's pounding on every door, begging to sell everything cheap, fast, now. What do? Do you sell with him? Do you panic? Or do you remember what you own? Do you check the business, the value, the earnings, and realize nothing fundamental has changed? That's when you start to see. Mr. Market is your daily test. Every quote, every graph, every tweet, he's trying to make you flinch. But if you wait, if you listen to your own analysis, your own conviction, you'll find that sometimes he's offering you deals that others are too scared to take. And that is where the intelligent investor thrives. Here's what most people get wrong. They think investing is about predicting what Mr. Market will do next. It's not. It's about preparing yourself so well that what he does doesn't matter. That is the quiet confidence Graham gives you. Not arrogance, not certainty, but a calm mind in a chaotic world. You learn to respect the market, but not to fear it. You learn to observe prices, but never be ruled by them. And slowly, day by day, you stop being the crowd. You become the counterweight. The intelligent investor doesn't react. He thinks. He waits. He acts only when the odds are in his favor. And he lets Mr. Market knock without ever needing to open the door. Let's step into part 5, where we explore one of the most profound forks in the road within the intelligent investor. Graham asks you to make a decision, not just about how you invest, but about who you are. He divides all investors into 2 types, the defensive investor and the enterprising investor. But this isn't about your net worth. It's about your temperament. The defensive investor is cautious. He wants simplicity, peace of mind, minimal effort. He doesn't seek to beat the market. He wants to avoid mistakes. He doesn't want to check the market every hour. He doesn't want adrenaline. He wants sleep. But here's the catch. The defensive path demands discipline, not just once, but forever. It demands you resist temptation, ignore fads, and stick to a plan that works quietly while others chase noise. The enterprising investor, on the other hand, is hungry. Not greedy, but curious. He wants to do the work. To research, to dig, to find hidden value. He's willing to study balance sheets, earnings reports, industry trends. He treats investing like a craft. But here's the twist. Just because you're smart, just because you work hard, doesn't mean you'll succeed as an enterprising investor. Because intelligence without humility is a trap. Graham warns that the market humbles even the most prepared. The moment you think you've figured it out, it shifts. The moment you think you're special, you begin to bleed. So, what's the real question? It's not whether you're defensive or enterprising. It's whether you can be honest enough to know the truth about yourself. Do you have the time, the skill, the emotional resilience to actively research stocks, to handle bad news without panic, to go months, years without rewards? Or are you someone who simply wants to build wealth without obsession, without drama, through proven, passive, stable principles? Both paths are valid. Both can lead to success. But they require different mindsets. Let's go deeper. The defensive investor builds a portfolio of high-quality bonds and blue-chip stocks. Not too many. Not too few. Well diversified. He follows a fixed asset allocation, often 50% stocks, 50% bonds, and he rebalances it over time, no matter what the market does. This is boring. But in investing, boring is beautiful. He avoids hype. He doesn't chase returns. He wins through consistency. Now shift your eyes to the enterprising investor. He's looking for undervalued stocks, companies trading below their intrinsic value. He's looking for bargains in places others ignore. But he's not following a gut feeling. He's running the numbers. He's analyzing the fundamentals. And here's where Graham does something brilliant. He doesn't say one is better. He says, know your edge and stay within it. Because the real danger? Trying to be an enterprising investor without the temperament or time. That's when mistakes become losses. That's when confidence becomes overconfidence. Let's be honest. Most people think they're enterprising. They think they can beat the market. They believe they can pick winners. But their results say otherwise. They're reactive, distracted, emotionally charged. That's not enterprising. That's guessing. And Graham has no patience for guessing. He offers you a choice rooted in realism. He doesn't promise success. He promises tools. And the first tool is self-awareness. Who are you really? The defensive investor must guard against temptation. The enterprising investor must guard against ego. Both must guard against emotion. And both must accept this truth. There are no shortcuts. Only systems. Only behavior. So stop for a moment and ask yourself not what you want, but what you're built for. Are you willing to commit to research? To handle volatility? To study industries and dive into earnings reports? Or do you want your portfolio to be a silent engine that runs in the background while you live your life? The intelligent investor is not a path for everyone, but it is a mirror for everyone. And when you choose your type, defensive or enterprising, you're not just choosing a strategy. You're choosing how you live with money and how money lives with you. Let's continue with part 6, where we dive into the actual building blocks of a defensive investor's portfolio, the strategies, the safeguards, the structure that protects you not just from loss, but from yourself. Imagine waking up during a financial crisis. Headlines scream, markets crash, people panic, and yet you don't flinch. Why? Because your portfolio isn't built on predictions. It's built on principles. This is the defensive investor's world. Graham's strategy begins with balance. At the heart of this approach is a simple but profound idea. Divide your investments between stocks and bonds. The classic 50-50 split. But here's the nuance. This ratio isn't set in stone. If the market crashes and stocks fall, you rebalance. If stocks rise dramatically, you trim. If bonds become overpriced or risky, you adjust. This rebalancing forces you to buy low and sell high, not by instinct, but by rule. It's emotion-proof. But here's where it gets even smarter. Graham doesn't just say, buy stocks. He says, buy quality. For a defensive investor, that means large, established companies with a long history of profitability. No flashy tech IPOs. No speculative small caps. You're looking for blue-chip businesses, the kind that survive war, recession, inflation, and scandal. Think companies that have paid dividends consistently for 20 to 30 years. Think stable earnings, strong balance sheets, simple products, global footprints. Why? Because in the long run, wealth isn't built on excitement. It's built on durability. And that applies to bonds too. A defensive investor avoids high-yield, high-risk bonds. They stick with high-grade government and corporate bonds. They know that a few extra percentage points in yield are not worth the risk of capital loss. Now here's the twist. The real magic of the defensive approach isn't just in what you buy. It's in what you ignore. You ignore market forecasts. You ignore hot tips. You ignore the friend who doubled his money in some once-in-a-lifetime opportunity. Because you understand, chasing returns is a game you'll lose over time. But avoiding mistakes? That's a game you can win every year. Think about that. In a world obsessed with maximizing profits, Graham says, minimize regret. In a world chasing momentum, he says, seek stability. In a world that fears missing out, he teaches, welcome stillness. This isn't passive investing. This is patient investing. Strategic, thoughtful, boring to the crowd, but beautiful to those who see it clearly. The defensive investor may not win every year, but they never lose big. And in investing, survival is underrated. You don't have to hit home runs. You just have to avoid striking out. And over 10, 20, 30 years? That's how legacies are built. So here's what your portfolio might look like. 50% high-grade bonds, U.S. Treasuries or AAA-rated corporates. 50% high-quality stocks, large, established, dividend-paying companies in different industries. Every year, rebalance to maintain that 50/50ths. Don't touch it based on gut feelings. Don't tweak it because of headlines. Just follow the system. That's the power of Graham's method. It's simple, but not easy. Because the hardest thing in investing is doing nothing when everyone else is doing everything. But the defensive investor knows, stillness is not weakness. It's strength under control. Welcome to Part 7, where the path takes a sharper turn. We now step into the world of the enterprising investor, the seeker, the researcher, the one who doesn't just want to preserve capital, but grow it. And yet, even here, Graham's voice is calm, cautioning, grounded. Because this isn't about chasing glory. It's about earning your edge. Most people think being an enterprising investor is about being aggressive. But Graham defines it differently. For him, it's not about risk-taking, it's about effort. The enterprising investor must be willing to dig where others don't, to do the homework, to study the numbers, to be curious, skeptical, and endlessly patient. And most importantly, to act only when the price is right. This investor seeks mispriced opportunities, not hype. He's not scanning news headlines. He's scanning balance sheets, searching for companies the market has forgotten, overlooked, misunderstood. But here's where things get interesting. Graham gives specific methods, not vague theories, methods. Let's start with one of his favorites, undervalued stocks trading below intrinsic value. That's the heart of value investing. Find companies whose real worth, based on earnings, assets, dividends, is higher than their current stock price. Then buy them. And wait. Not hope. Not guess. Wait. Because Graham believed the market is a voting machine in the short term, but a weighing machine in the long term. Eventually, value wins. But in the meantime, you need conviction. You may hold a great company that keeps dropping. You may be right for months while the market says you're wrong. That's the price of being early. That's the burden of seeing clearly while others are still confused. Now let's take it deeper. Graham taught about net stocks, companies trading for less than the value of their current assets minus all liabilities. Imagine buying a business for less than what you'd get if it shut down today and sold off the chairs and printers. Sounds crazy? It worked. For decades, this strategy crushed the market. But it required courage, because these weren't pretty companies. These were beaten down, ignored, often messy. But Graham didn't care about story, he cared about math. He also explored special situations, mergers, liquidations, spin-offs, companies with a temporary issue but a permanent value. These are complex, but if understood correctly, they offer high reward with controlled risk. And that's Graham's secret. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Notice the words. Thorough analysis. Safety of principal. This isn't gambling. The enterprising path requires you to think like an owner. Not a trader. Not a speculator. An owner. You're not buying tickers. You're buying businesses. And when you find one worth owning, priced irrationally, you step in. Not because everyone else is doing it, but because no one else sees what you see. But here comes the hardest part. You must remain unmoved by the crowd. Because while you wait, others will doubt you. They'll mock your old-fashioned approach. They'll say value investing is dead, that the market has changed, that this time is different. But the enterprising investor smiles. Because the market never changes. It always swings between greed and fear, between irrational highs and panic-driven lows. And every time it does, the intelligent, enterprising investor is waiting. He's not smarter, just more patient, more principled, more prepared. Now we step into part 8, where Graham turns us toward the past, not to reminisce, but to arm us. Because the stock market, for all its glamour, is not a mystery. It's a cycle machine. It repeats again and again. And those who don't study its history, they don't just fail. They relive its worst chapters. Graham opens the door to a timeline of booms and busts where optimism turns to euphoria, then to denial, and finally to collapse. Not once, not twice, but again and again and again. Let's travel back. The roaring 20s are in full swing. Stocks soar. Everyone's getting rich. And then it breaks. The crash wipes out fortunes. Bank runs begin. Wall Street burns. A decade-long depression follows. But you might ask, that was almost 100 years ago. What does that have to do with me? Everything. Because human nature hasn't changed. People still chase hype. They still believe this time is different. They still forget that trees don't grow to the sky. Next stop, 1949. After war, depression, and despair, a quiet rally begins. Stocks are cheap. Dividends are high. But nobody cares. Investors are too scared. And yet, that was one of the best times to invest in history. The smart money didn't wait for headlines to turn optimistic. It acted on value, not emotion. Then comes the 1960s and early 70s. Markets explode. The Nifty 50 dominate, giant companies considered invincible. Investors believe these stocks are safe at any price. And Graham watches, horrified, because he knows no company is safe from overvaluation. Not Coca-Cola, not IBM, not even Disney. Then it crashes again. A brutal bear market from 1973 to 74. The invincible stocks? Cut in half. Or worse. And once again, Graham is right. The pattern is clear. Every peak is followed by arrogance. Every fall is followed by opportunity. So why do investors still fall into the same traps? Because they don't study this. Because most investors operate like amnesiacs. They feel smart when prices rise. They feel betrayed when they fall. And they never ask, what's happened before? Graham teaches that history is your shield. If you've seen past crashes, you won't be shocked by the next one. If you know what euphoria feels like in 1999, you won't fall for it in 2025. He says, the investor's chief problem, and even his worst enemy, is likely to be himself. And that's the point of this chapter. It's not just about what the market has done. It's about what you do when it happens again. When prices rise too fast, do you rush in or step back? When prices crash, do you panic or prepare? History gives you context. It humbles you. And it reminds you, you are not the first to feel this fear, this greed, this confusion. Others have been here. Some were ruined. Some were patient. Which side are you on? That's the question Graham asks. Not with charts, not with jargon, but with quiet, relentless clarity. Because if you know your history, you're not just investing with money, you're investing with memory. And memory, unlike emotion, doesn't lie. Now we arrive at part 9, where everything that's come before emotion, value, history converges into one idea. A single principle that might just be the most important in all of investing. Margin of safety. In engineering, bridges are built to handle more weight than they're expected to carry. Planes are built with redundant systems. Skyscrapers are designed to withstand winds far stronger than they'll likely ever face. Why? Because life is unpredictable. And in uncertain worlds, you don't gamble on perfection. Graham applies the same logic to money. A good investment isn't one that only works if everything goes right. A good investment is one that still works when things go wrong. That's margin of safety. You don't buy a stock for $100 just because you think it's worth $100. You buy it for $1.70 or $1.60 or less. Because you know your analysis might be flawed. Because you know the future is cloudy. Because you respect the unknown. Margin of safety isn't pessimism. It's humility turned into strategy. And here's the brilliance. It turns uncertainty into opportunity. Because most investors need everything to go right. They chase perfection. They count on flawless execution, endless growth, perfect timing. But you? You only need a few things to go less wrong. That's a much easier game to win. Let's look at an example. Suppose you find a company with assets worth $100 per share. It's currently trading at $60. You do your research. You account for risks. Even if some assumptions go bad, maybe the real value is $80. You still win. That's the cushion. That's the margin. That's how you sleep at night while others toss and turn. But Graham takes it even deeper. He says, margin of safety is not just a calculation. It's a way of thinking, a way of living. It means you avoid debt not because it's always bad, but because it leaves no room for error. It means you save more than you spend, not because you're scared, but because you value resilience. It means you invest not to impress, but to endure. Because the market can crash, a company can disappoint, life can surprise you. But if you've built your plan with margin of safety, you bend, but don't break. And that's the real secret. Wealth isn't about maximizing every return. It's about minimizing regret. It's about surviving the long game. Because in the end, the investor who wins isn't the one who took the biggest risks or chased the flashiest ideas. It's the one who never had to start over. And Graham leaves you with this. The market will always be uncertain. Valuations will fluctuate. Predictions will fail. But margin of safety? That is your anchor. Your parachute. Your armor. It won't make you rich overnight, but it will keep you from ruin. And in the world of investing, that is the greatest superpower of all. Now, in part 10, we meet one of the most vivid and unforgettable concepts Graham introduces, Mr. Market. Imagine you have a business partner named Mr. Market. Every day, he shows up at your door with a different price for your share of the business. Sometimes he's optimistic, offering a high price because he's euphoric. Other days, he's gloomy, offering a rock-bottom price because he's fearful. But here's the catch. Mr. Market doesn't base his prices on reality. He's driven by emotions, greed, fear, hope, despair. He's unpredictable. He's irrational. And he's completely out of your control. Most investors let Mr. Market's mood dictate their actions. They buy when he's ecstatic, paying too much. They sell when he's depressed, locking in losses. But the intelligent investor? He treats Mr. Market like a friend who is often irrational. He doesn't let Mr. Market bully him. He doesn't accept every offer. Instead, he uses Mr. Market's mood swings to his advantage. When prices are too low, he buys. When prices are too high, he waits or even sells. It's not about timing the market perfectly. It's about discipline and rationality. You don't have to agree with Mr. Market's price. You only decide if the price makes sense based on your analysis and margin of safety. And here's the secret: Mr. Market is there to serve you, not to guide you. If he offers you a good deal, take it. If not, ignore him. But never get pulled into his mood swings. Because the real battle isn't with the market, it's with yourself. Graham's Mr. Market is a powerful metaphor that teaches investors how to emotionally detach from daily market noise. Because if you chase every price Mr. Market offers, you'll end up exhausted and broke. If you ignore him completely, you might miss rare bargains. The balance is subtle but critical. It requires patience, self-control, and clarity. And it's why Graham calls investing more a psychological game than a mathematical one. Here's part 11, where Graham guides us through the practical side, building a portfolio rooted in the principles we've explored, while steering clear of the psychological traps that trip up even the smartest investors. Investing isn't just about picking good stocks. It's about managing your mind. Graham knows this well. He warns against the most common psychological pitfalls that destroy wealth faster than bad market timing. First, the temptation to chase recent winners. When a stock or sector is hot, everyone wants in. The herd mentality is irresistible. But Graham says, the investor's chief problem, and even his worst enemy, is likely to be himself. Because when the crowd rushes in, prices often skyrocket beyond true value. Buying at these peaks is the start of regret. Second, panic selling during downturns. When markets fall, emotions flare. Fear paralyzes or forces impulsive selling at the worst possible moment. The margin of safety cushions, but without discipline, even the best analysis fails. Third, overconfidence. The belief that your insight or luck can beat the market consistently. Graham reminds us that luck is fleeting and humility is a lifelong companion. So how does Graham suggest you build your portfolio to resist these traps? For the defensive investor, it's about simplicity and balance. Stick to high-quality, dividend-paying stocks and bonds. Avoid fads and hot tips. Maintain a consistent allocation and rebalance regularly. Think long-term, not day-to-day. For the enterprising investor, the work is deeper but disciplined. Research undervalued companies thoroughly. Avoid overpaying, even for good stocks. Use margin of safety to protect against errors. Keep emotions in check during market swings. Most importantly, Graham teaches that successful investing is a marathon, not a sprint. You will face moments of doubt, confusion, and fear. You will see others make fast money and feel the urge to follow. But those who survive and thrive are the ones who stay true to their principles. Because the market is not here to make you rich overnight. It's here to reward patience, discipline, and thoughtful action over decades. And if you master this, you don't just build wealth, you build freedom. Now, in part 12, Graham closes with a message that echoes beyond markets and money, one about mindset, endurance, and the kind of wisdom that turns investing from a gamble into a lifelong journey. He reminds us that no matter how much you study, analyze, or strategize, uncertainty will never disappear. The future remains unknowable. That's the reality every investor must face. But here's the truth that changes everything. It's not about predicting the future. It's about preparing for it. Graham urges us to embrace a mindset of humility and caution, balanced with courage and patience. He says the intelligent investor must be ready to accept imperfection, both in the market and in themselves. Because mistakes will happen, losses will come, and emotions will try to take over. What separates success is how you respond. Will you panic and sell? Or will you steady your hand and hold? Will you chase the next big thing? Or will you stick to the principles that have stood the test of time? Graham's final wisdom is to treat investing not as a game of chance, but as a discipline, a craft, a commitment to ongoing learning and self-control. He encourages investors to see their portfolios as partnerships with themselves, a reflection of their values and character. And in this partnership, consistency trumps brilliance. Because brilliance without consistency is just luck. But consistency built on intelligent principles, backed by margin of safety, patience, and knowledge, is resilience. This isn't a promise of quick riches. It's a promise of survival. A promise that if you walk this path steadily, the market storms will not sink you. And with time, your small, steady gains will compound into true wealth. That is the legacy Graham offers. Not hype, not magic, but the quiet power of intelligent investing. As we close this deep dive into The Intelligent Investor, remember, it's not just a book. It's a guide to thinking differently about risk, value, and yourself. And that mindset, more than any stock or strategy, is your greatest asset. So now, after walking through every chapter, every principle, every story Benjamin Graham carved into the pages of The Intelligent Investor, you might be wondering, should I still read the book? And my answer is simple. Yes, absolutely yes. Because what you've heard today is just a glimpse. The real transformation doesn't happen from listening. It happens when you sit with the words yourself, when you mark the pages that challenge you, when you wrestle with the ideas that feel uncomfortable, when you begin to think not like a gambler, but like a steward of your own financial future. This book is not a map. It's a compass. It doesn't give you shortcuts. It gives you something far better. Clarity. Clarity about risk. Clarity about fear. Clarity about how to protect what you've built and grow it with integrity. Read this book slowly. Read it deeply. And most importantly, read it more than once. Because as your understanding grows, so will the meaning hidden in these pages. And before you go, if this journey gave you even a single moment of insight, a shift in thinking, a spark to learn more, then don't leave it here. Subscribe, not just to the channel, but to the journey of becoming smarter, calmer, and more intentional with every rupee, dollar, or decision you make. This is just one book, but it could be the beginning of a whole new chapter in your life. See you in the next one. Stay intelligent. Stay patient. Stay invested.